Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, Roy Matlock Jr. here today, and we are talking money, and we'll be over the next few minutes talking about protecting yourself, and let's talk about avoiding financial mistakes and building a foundation. A lot of times people wonder, why it's not working, and a lot of it gets back to we just don't plan. All right, and so today we're going to talk about the boring stuff that will help you get going and automate your financial independence. And so if you're thinking about, your money is, you got too much month at the end of the money kind of things, this will be a good show for you. What I'm going to be doing is kind of walking through a step-by-step plan, mostly geared around avoiding mistakes, protecting what you have. This is not going to be about let's figure out how to get 10% on our money or anything like that. We do that on other shows. And if you want to get more details, you can always listen in to our podcast, and it's on every major podcast. You can also go to RoyMatlockJr.com. It's called the Roy Matlock Jr. Money and Business Hour. So let's get started. So everything begins with a GPS. The GPS, if we're going to go somewhere, first thing we want to do is, figure out where we want to go. If you get in your Uber or and you start out, the first thing you have to do to even get an Uber is say, where do I want to end up? And then it's going to tell you, what it's going to cost. And then if you follow your map or anything like that, it's going to tell you how to get there. And goal setting is the most important thing. And so what we want to do is we want to go in with the mindset that in order to move forward, we need to be saving on a low end 10% of our income. So if we're making $100K, we need to save 10. If we're making $200K, you should be able to save in more than that. All right. But on the low end, you want to be looking at it like that. So if we can save 10%, that's our first number. So take your income, multiply that times 10%, and that should be your automated savings that's going to go out. And then what we do in our goals, we come out and we say, well, we want to have $100,000 a year, do nothing money. We start by a number. That number is $100,000. We multiply it times 20. That's $2 million. That's our number. Then we're going to add inflation to it. So say it's 20 years from now, then you're going to come up with whatever the inflation is at 3%, whatever it is, and you're going to come up with your financial independence number. That number is the amount of money you need to have so you can quit and permanently end up having money that you can live on forever and that's never going to go away. Once we do that, we then back it into an assumed rate of return, long-term, maybe 9 or 10% if you know where to put your money. We put that in, and we come back and we say the financial independence number is $632 a month, whatever that number is. And then what we do is we automate $632 a month automatically out of our checking account, automatically out of our paycheck if we have a retirement plan through work, and we have just automated our financial independence. So you got to know the numbers. So we start with that. Then you say, well, how do we get all this going? Well, we set up a budget. So if you go to RoyMatlockJr.com, you'll be able to find and download a budget form. It'll calculate all this stuff for you. The most important thing you can do to get your money right is to get on a budget. A budget is not an accounting system. So we're going to talk about the difference in an accounting system and a budget. A budget pre-plans in advance what you're going to spend, and it has ways of keeping you on track. An accounting system is counting up what you've already spent. So what we're going to do is we're going to get on a budget. How do we do that? We have several accounts that we start with. So we start out, we pull the budget form. Go to RoyMatlockJr.com and download the budget form. You go through all of the expenses. To start with, we should fire all of our expenses and look at the ones that we really need and that we really want to rehire. Then we start from there. Some of them we can't get rid of. Some of them we got to work to get out of. For instance, I had 2 car payments in 1986, 2 car payments, $600 a month in car payments. I thought I was cool. I bought 2 new cars. And when I figured out I was stupid to have done that, I ended up working to pay down those cars to where I could get out for I was upside down in them so I could get rid of them. I then bought 2 cheap cars, still had to finance them, and paid those off immediately, and that was the last car payments that I had. And so what happens is once you figure this stuff out, you're like, all right, I'm not going to have car payments. I'm not going to have credit card bills. I'm not going to have that stuff. All right. I'm going to get on a budget, and the way we do it was take our income, 100% of our income goes into an account. If you're married, you would have all income going into one account. Out of that, you would set aside money, okay, for future expenses that will occur, such as a new car purchase one day that you'll end up buying. All these different things. It's built in, maintenance, Christmas, vacations, all that kind of stuff. All the money comes in. You spend all the money on paper. You then include in that paying yourself, which is your savings, that 10% that you're going to be putting aside. You're going to have all of your other expenses, insurance, and you name it, all that. And then you're going to have your weekly expenses. I recommend that you have 2 debit cards. The debit card would be a way for if you're married, you have all of your money going into one place. Then you have a debit card. That debit card, you move money out each Sunday onto the debit card. Each of you have that debit card for your weekly expenses. So when you go, get gas and different things like that, if you eat out, all that kind of stuff, and you come up with that number, whatever that number is. So let's just say for this sake, you get $200 a piece. That $200 a piece is for miscellaneous stuff, and you set up a automated text or email every morning that tells you how much money is left. And all you're having to do to be under budget, on track, is manage $200 a week. Anybody can do that. And you get something sending you a reminder how much money you have left every day. So then at the end of the week, you look, you say, well, I've only got $28 left in my account. I don't think we can go out to lunch or dinner or whatever it is. And that is going to be the end of the week. And then I'm going to add, if I want to be under budget, another $172 to that 28 to get my $200 for the week to get started. Then when maintenance happens and your car has to be replaced, that account where all of your income has been coming in has been growing. You will pull that money out then, pay cash, you're on track. That is the makings of a budget. I even call it a draft account. So we automate all of our bills. We automate all of our savings. So today's show, we're going to talk about avoiding mistakes. My name is Roy Matlock Jr. If you would like more information on anything regarding money, visit roymatlockjr.com. We will be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit roymatlockjr.com. Now, here's your host, Roy.
All right, if you're just tuning in, Roy Matlock Jr. here, and we are talking money. Been doing it forever and ever and ever. I went on the radio for the first time in 1992. It's crazy. So, but I like it. I like helping people when it comes to managing what they do. And today's show, if you're just tuning in, is about setting up all the boring things. The first segment, you can visit roymatlockjr.com and get the podcast. It was about how to set a budget up and set your goals up to automate your financial independence. So what we've done now is we started out, we had our GPS. Our GPS is our goal, our plan, our schedule. That means, what do we want? How are we going to go about doing it? And when is it going to happen? And we come up with our number, our financial independence number. We call it the FIN number. So we have a FIN number, financial independence number. We set a budget up. We take our income and we make sure under all that we absolutely save 10%. Ultimately, if you manage your money well, you'll get excited about it, and chances are you'll be, as your income goes up, you'll be able to even save a bigger percentage. But 10's your number. So take your income times 10%. That's what we need to be automating into a savings type investment program. What I mean by automating, either it's automatic out of your paycheck or it's automatic out of your checking account. You pay your house payment every month. Might as well pay yourself every month. And so that's how you get things going. We pay ourselves first. We have that built into the budget. We eliminate all car payments, credit cards, bad debt. Bad debt is anything that you can't afford, number one. And number two, it's something that is tied to something that depreciates. So you never finance depreciating assets, or they're not even assets, depreciating things. An asset is something that grows. And so that's why having a mortgage is okay as long as you can afford it and continue to save your 10%. So then once we do that, we're going to start preparing for things that could happen to us. For instance, we prepare in the budget for maintenance, things like that. So when the car breaks down or you got to get new tires, you already have that set aside. But the other thing we prepare for are emergencies. Emergencies happen. You get sick, something happens, you lose a job, whatever it may be. The last several weeks here in Nashville, there for a lot of people, they had damage to their house, they lost their electricity, but in many cases they weren't able to go to work. And so not only did they get hurt, with maybe damage to their property, they also got hurt because they didn't make any money during that time. And so an emergency fund is designed to have staying power. What is staying power? 3 to 6 months of your income. If you're both working, 3 months is probably okay. If you're married, if it's only one of you, you probably want to have 6 months set aside. Why do we do that? Well, how do we get a return on the emergency fund? Typically, we'll put it in a money market account. Right now, maybe 3.5%, something like that. So it's not a big rate of return, but where does the return come when it comes to your emergency fund? Well, the first return is that you don't lose assets. And what do I mean by not losing assets? Well, if you were to have 6 months of an emergency fund and you lose your job, you're going to be able to pay your house payment. You're going to be able not have to pull from your retirement plan and pay penalties. So we're going to make our money by not having to do things that cost us money. Other things that an emergency fund allows you to do is allows you to, on an older car, maybe take the risk and drop the collision insurance. If you have a car payment, you have to have it. If you don't have a car payment, and I have a car right now that I don't carry, all I carry is liability on it. Saves me several $1,000 a year by doing that. I take the risk. Now, if I total the car, I have to pay for it, but I have the money set aside that I can do that. So therefore, I save money on my insurance, on my car insurance. I can raise my deductibles on my home and auto insurance. I can raise the deductibles if I'm buying my own health insurance. So therefore, my premiums go down. I can be more self-insured as a result of those kind of things. The emergency fund is designed to keep you from paying penalties for not having the emergency fund. So penalties are things like your retirement plans, having to withdraw them, all those kind of things. So we set that into our budget, an emergency fund. When should you begin? If you begin with nothing, what a lot of times people say, well, what about my 401k, my match, and all that? Here's what I typically tell you. If you're working and you don't have bad debt, credit card debt, stuff like that, and you're working to get yourself maybe completely debt-free with your car payment and all that kind of stuff, you might take a portion of your money and put it toward the emergency fund, maybe 5% of it, and you put 5% towards your retirement plan. But the long and short of it is you draft it. You automatically deduct it out of your account, so it's set aside on a monthly basis, and it's done. So here's what happens. If you, say, need a $10,000 emergency fund and you're making $100,000 a year, whatever it is, or maybe you need, $20,000, you're going to just plan it out, and it's going to be automatically drafted. And then once that draft hits that number in that money market, then at that point, you stop that draft and it goes into long-term savings. And so all of this is set up with the mindset that you don't have to do anything. You have all of your bills that you owe automatically deducted out of your account. That is your draft account is what we call it, where all the money goes in. We have all of our savings going automatically out of it. And then what we do is we take and manage weekly our expenses. Once we've done that, we start seeing magic happen. Number one, you're like, wow, I'm saving money. Wow, I spent less than $200 this week on my miscellaneous spending. Wow, I was under budget. Wow, I don't have credit card debt anymore. Whoa, I can't believe this. All of this stuff is happening. Why? Because you planned on it. Anything you manage, I've come to the conclusion, I don't care what it is you're trying to accomplish. Anything that you put on paper and you manage it, all right, and managing it is putting it on paper and accounting for it. In other words, did I do it? Did I do my push-ups today? Whatever, and you write it down. Anything you do, you improve it 20% right off the bat. So when you start doing this, you're going to find that money magically is there, and you're like, wow, I didn't know that. Used to, I was always living paycheck to paycheck. It's not happening anymore. If you have debt, let's talk about what should we do with debt. Debt will erode your ability to save. So what you want to do is you want to make sure that when you engage in debt, you know the difference between what is called good debt and bad debt. All right, so I'm going to give you an example. Bad debt, you can't afford to pay the payment. It stresses you. All right, if you purchase something and you're going to be obligated to a payment and it makes you nervous, that should tell you something. So we start out and we say no bad debt. Bad debt is something that is something we can't afford. And number two, it's tied to something that goes down in value. Good debt is something that we can easily afford that's tied to something that goes up in value. So what would be things that would qualify? You could borrow money on a home. You could borrow money for some equipment to go in to help your business grow. Or you could put money into different things that grow as an asset. All right. That's why people, when they buy rental properties, they put a percentage down, typically 25% down is required, and they borrow the rest. And that is an asset that goes up in value, and they collect rent that pays the payment. So this is the way you look at debt. Bad debt, can't afford it, tied to something that goes down in value. Good debt, can't afford it, tied to something that goes up in value. Should you pay your 3% house off? Absolutely not. Worst financial advice ever given, all right, is to pay your home off when you have a low interest loan. It just makes no sense. Those are like gold. It was like free money. Don't ever do it. All right. Any rate of return that you get is the rate of return that you're paying down. So the rate of return on a 3% mortgage, if you pay it down, is 3%. All right. If you got a 2.5% mortgage, 2.6, whatever it was, 2.6 is your rate of return. A 4%, 4% is your rate of return. You're paying it down. Put that money into something that can grow. So this is the kind of things that we do. We avoid making bad decisions. When we come back, I'm going to talk about other things like buying the right insurance so you can save money, things like that. My name's Roy Matlock Jr. Visit roymatlockjr.com. We'll be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit roymatlockjr.com. Now, here's your host, Roy.
All right, we're back. Roy Matlock Jr., and we are talking money. And today's show is all about avoiding mistakes and setting up a foundation to be able to get financially independent. If you're just tuning in, always go to roymatlockjr.com or to any of your podcasts, and you can get all of these first segments. But so far today, we've been talking about goal setting, how to set up a budget that works, the importance of an emergency fund and how you get your rate of return on an emergency fund. We also talked about good debt and bad debt. What's the difference? Good debt, you can afford easily, tied to something that goes up in value. Bad debt is something that is not easily affordable, and it goes down. Whatever item you purchase goes down in value. Another part of the emergency fund is your equity in your home. I always recommend, if you have a decent amount of equity in your home, in other words, more than 20%, to go ahead and set up a equity line of credit. You don't have to use it, but it gives you liquid cash in the event something happened or you had an opportunity to come along. So I always like to look at equity in the home as, potentially an opportunity that you could get to the money. And the way you get to it is you have an equity line of credit when you don't need it. That's when you set it up, when you have your income's up, your credit's up, all that kind of stuff. Banks are funny. They love to loan money to people that don't need it, and they hate to loan money to people that need it. That's just the way it works. All right. So now what we've done, we've gotten ourselves in a position to where we spend less than we make. We automate our savings and our bills. We have money left over in our account to cover maintenance, new car purchase, all the different things. So we don't have payments in the future. Our emergency fund is funded 3 to 6 months, depending on if you have 2 incomes. Maybe 3 months you can get by. 1 income, more like 6 months. We use the emergency fund to reduce deductibles or increase deductibles, reducing our insurance cost, things of that nature. We get rid of the bad debt, only have good debt. Now we go buy insurance. Let's talk about insurance. There's a lot of types of insurance. I'm going to give you, starting with the way insurance is designed. Insurance is designed to protect either your income or your assets. That's how it works. And if you think about income, life insurance, disability insurance, things like that, you have long things to protect your assets will be your home and auto. If you have a wreck, you have your liability coverage, protects your assets. Somebody sues you, long-term care protects your assets, all those kind of different insurance. Health insurance protects your assets. So what we do is we protect our income and our assets. So let's talk about protecting our income to begin with. There's 2 types of things that you're going to be looking to purchase. One of them is a life insurance policy, and the other one is a disability income policy. What is the difference? Well, a life insurance policy is broken into 2 types of policies. One is called a term. Another one is called a permanent coverage. The difference in the 2, term insurance is designed if you die. And what do I mean if you die? If you die is when you have young children, you may have a mortgage, you want to educate your kids one day, your family is depending on you, the money machine, to be able to provide that check every week, to be able to feed and clothe and house and all the things that go along with that. So we buy term insurance for a period of time until we get financially independent. And financially independent means that we have enough money set aside to be able to pay for all of our expenses off our investments. So let me give you an example. Kind of a rule of thumb, if you buy life insurance, if you're buying term insurance, first thing, it's called term because it is for a term. So you can get generally between 10 and 35-year term. What that means is the coverage remains the same and the premium remains the same for the term of the coverage. At the end of the term, the premium will go up and you will have to renew it, but maybe at that point you've gotten yourself financial independent. So let me give you an example. So let's say you're making $100,000 a year, and we'll divide it 2 ways, 50-50. What's going to happen is this: $100,000 is what we need for a period of time. So one of the ways that we look at that is we look at about 10 times your income plus paying off any debts, maybe educational funds set aside, stuff like that. So let's say that your combined household income is $100,000 and you are working, both of you making the same income. You would need about $500,000 apiece. That would replace a lot of your income. You pay your mortgage off. You owe a $300,000 mortgage. So that would be $300,000 more, and you set aside some money for the kids. So you might need $1 million of term insurance, all right, each. How much is that going to cost? It's very inexpensive, all right. Typically, someone that's young getting that, you get $1 million of coverage for less than $100 a month, all right. So why wouldn't you do that? Wouldn't it make sense to have enough coverage if something happened that your kids are going to be taken care of, and your spouse and whoever's dependent on you? So that's term insurance, and we buy that typically until we're financially independent. So now let's say we had accumulated $2 million. Now we could get it 5%, $100,000 a year. We wouldn't need the term insurance anymore. We bought it for a term, but it's the most valuable coverage when you're getting started and you're not financially independent. The second type of coverage you would buy would be something for when you die. They call that permanent coverage. It's used for a couple of different things. One, it can provide an estate, and it will clean up any of the cost involved when you pass away. Additionally, you may still need some income to leave behind because, Social Security's one of the Social Securities, if you're married, goes away. There's expenses, funeral expenses, sometimes medical expenses. So people keep coverage permanently, and that's called a permanent life insurance policy. The ones that we typically tell people to get might be a variable life or an indexed universal life, one of those type of products. You can keep it for as long as you live. So term eventually will typically go away at age 70 is a typical, and a lot of times they will let you renew it, but it becomes very, very unaffordable. So that's what we do with the life side. So we protect our income that way. Disability income, you buy disability income to replace your income should you be unable to do your job. If you are, for instance, a doctor, you would buy disability income that would cover you in the event you could not do the work of being a doctor. That doesn't mean you can't do the work doing something else. So, for instance, if you're a surgeon and you're making $500,000 a year and you break your hand and you can no longer do surgery, that doesn't mean you can't do other things. It just means you can't do surgery. But the other things that you do are not going to pay you $500,000 a year. And so you would buy something that would cover you in the event you couldn't do your specific type of work, not just if you were completely disabled, things like that. You buy that, typically about 60% of your income is what you would insure. That's what the insurance companies are funny. They will only sell you insurance. The idea is to indemnify you back to where you were. So therefore, you're not going to go buy $10 million of life insurance when you're only making $100,000 a year. You're not going to be able to buy twice your income that you're making on disability, because it would make sense in the form of you might just get disabled on purpose, all right, because you're making more money not working than you would be working. And so we buy those kind of things to protect our income. Then we go in and we protect our assets. One of the number one causes of bankruptcy is people don't have health insurance. And it's interesting about that for most people that don't have health insurance, you can get it for cheap. It's not that expensive, and everybody thinks it's so expensive. But if your income is down, you actually get subsidies from the government. And so there's ways to cut your cost when it comes to health insurance. How do you do it? I've been doing this for many, many, many years, all the way back. My 34-year-old daughter, I negotiated with the hospital for the cost of delivery, and I had high deductibles that saved me money. I've always gone with high deductibles. Saves me premiums, and then what's called a catastrophic insurance, or now a health share. You do that the bigger the risk that you're willing to take, the lower your premium. Why are you willing to do that? Because you have your emergency fund. And so what we're doing now, we're getting all these basics down. So we're getting life insurance, disability insurance. We're going into health. We'll be talking about other stuff when we come back. My name's Roy Matlock Jr. Stay tuned. We'll be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, Roy Matlock Jr. here, and we're finishing up today's show. And this show today is about the boring stuff, the stuff that you need to do that you don't get around to doing it, and like things like having written goals and budgets and emergency funds, and managing and controlling bad debt, keeping yourself in a positive situation, automating your financial independence. And so we're talking about this. So if you're tuning in right now, I went into very detailed ways to set a budget up. So you need to go find this show, and it will teach you how to set a budget up, which is the foundation for getting ahead. Your goals, how to set goals, how to build, why the emergency fund. People are like, well, I don't want to have that money sitting and getting nothing. No, it's getting a great rate of return if you do what you're supposed to do with it. How to stay out of debt, stay out of car payments and credit card bills and all that kind of stuff, and manage your debt correctly. We just got through talking about buying the right life insurance. 10x your income is a good rule of thumb. You buy term if you die. An unexpected death wipes out a family. I've had, story. I've been doing this for 40 years, and I got my insurance license 40 years ago, and I've had people, young families, that lose a breadwinner, and where we were able to provide them term life insurance and get it get it in place, and then, you can't replace the person, but you can replace their earning power. And we do all that kind of stuff. And if you are looking right now at life insurance, we have pretty much all the companies. So one of the things that I always tell people, there's no excuse for not having term life insurance. One of our providers will issue you, if you're in good health, can issue you an insurance policy, and we can do it in about 10 minutes, up to $2 million of life insurance in about 10 minutes, term life insurance. And it also includes a will and trust. So there's no excuse for something like that. You can call 615-843-2999. That's our office number, or you can visit roymatlockjr.com, and literally in the next 10 minutes, you could get your insurance set up where you don't have to worry about that. And so we want to buy the proper life insurance. We then go into looking at our health insurance. Don't be without health insurance. I mean, that is just plain dumb. I mean, the government website, at the very least, go there. You may, if your income is down and you think you can't afford it, you get subsidies to do it. So one of the ways that I've always told people, as you build your emergency fund, you also should raise your deductibles on your health insurance. You can do that, and it will reduce your cost. I have had $1,500 deductibles forever, and $7,500 deductibles forever. And the reason I do that is, A, I've got the $7,500, and B, I negotiate on things. When I go into, I went in and got an MRI on my hand. I had a place on my hand I had to get looked at. It was going to be like $1,700, and I said, "What's your cash price?" And they said $450. I'm like, "Okay, I'll pay $450." I always get the cash price. And, if I'm not going to hit my deductible anyway, why would I put pay $1,700 against my deductible when I can pay cash? All right. And I do that. That's what health shares do. There's also things called health savings accounts. You can put over, if you're married, over $8,000 a year in, over $4,000 a year individually, and deduct it off your taxes. And then once you hit 59.5, it can be turned into the equivalent of a Roth IRA. And so you can take that money out tax-free. So you've got all of these options, but you got to look into it. Right now, with all of the damage in and around Nashville, one of the things that we see, and I hear this all the time, well, does your homeowner's insurance cover the trees? Or does your homeowner's insurance cover this? I had to move out of my house. Does it? When you buy stuff like this, you don't want to ask that question after the fact. You want to know in advance. And so let me give you some ideas if you have damage right now that you need to consider. We have vetted out some public adjusters to be able to help you with this. You can reach out to roymatlockjr.com, or you can call our phone number, and we will get you in touch with a public adjuster. What is a public adjuster? Well, insurance companies that, let's say you have homeowners insurance and your house is damaged. You don't really know the amount of damage. So here's what you do. You call your insurance agent. Your insurance agent tells you that they're going to have an adjuster come out. An adjuster comes out and says, this is your damage. Now, keep in mind, the adjuster is not a bad guy, but the adjuster more than likely works for the insurance company, or if they are an independent adjuster, they're still working for the insurance company. The insurance company is a for-profit company, and they might overlook some things that need to be fixed that you don't know about it because you're not a professional. You probably don't have trees falling on your house that often or pipes busting. And unless you're in that business, you probably don't know all the damage that could be there. So then what happens? You settle with the insurance company, and 2 years later, you find out that all your drywall has to be tore down because you have mold. And you didn't know it, but it was there. You just didn't know it, and it's too bad, so sad. You are now having a real problem, and the insurance company's already paid up. So what you want to do is you want to get with a public adjuster. If you have any type of damage, a public adjuster works for you. And interesting enough, a public adjuster will get you about twice as much money, and they typically charge based on the increase that they get you rather than you going through an insurance company adjuster. Just a little side note. So it's called a public adjuster. So we've got that. We now have homeowners insurance. We have an emergency fund. We raise our deductible maybe to $2,500, whatever it may be, $1,500 to $2,500, saves you money on that. We then, on our car insurance, we raise our deductibles as well to $1,000 or not a $250 deductible, whatever it may be. You want to make sure that your insurance is up to date. So with inflation, that you've got proper coverage in the event something happens to replace whatever gets damaged. Additionally, you want to look at your liability coverages. So for if you have a wreck and you hit a Mercedes and you don't have proper liability, then you're gonna come out of pocket and get sued to do that. So you want to look at potentially buying what's called a umbrella policy. It's an additional liability policy. I had an really, it was a joke, but I rolled into a delivery truck and the guy claimed, all these problems and stuff like that. And I think it was because he saw my car and he thought, well, I'm going to sue this guy. So they sued me, and I had my umbrella policy. I had a phone call or two with the insurance company's lawyers, and that was the end of it. I always tell people an umbrella policy is a cheap lawyer. All right. And so what you want to do is you want to let the insurance company pay for the liability. You buy an umbrella policy, an additional liability policy, and it covers you, personal liability, stuff like that. Somebody gets hurt at your house or you have a wreck or anything like that. So we do that. So now what we've done is we've bought life insurance, we've bought disability insurance to protect our income, we've bought home and auto insurance plus a personal umbrella policy, which is going to keep us in the event we get sued or any damage to our property using a public adjuster rather than just the insurance company adjuster. So we're moving in the direction of not having problems. We're getting our game on. We then go, we get the proper health insurance. You want to look at getting higher deductibles and high limits. So therefore, you're out of pocket, $7,500, but that's it. All right. And it's several $1 million of coverage in the event something happens. So we have those kind of things. So now we've got that happening. Long-term care is another example. You can buy insurance or you can add riders to annuities, which is typically a better way of doing it. I see annuities that you put in $100,000, it's getting 3%, something like that. And they pay up to 3 times that in the event you are in a nursing home facility or any kind of 2 of the ADLs, activities of daily living that you can't do. And so that would be a way to protect your assets. So what we're doing now, we've gone through, think about this. We've got a budget, emergency fund. We've gotten out of the bad debt. We only have good debt. We cut all these costs out. We've raised our deductibles. We now have money freed up because we have the emergency fund. So now what we're doing is we're getting ourselves in a position where we can really crank out the savings. We're on a budget, so we're not overspending. We got all these kind of things, and then we're automating our investments, and then we start going on the offense. One more thing that you want to be aware of and you need to have is a will and trust. If you have any assets or you have children, or if you have grown kids, you want to make sure you have healthcare power of attorneys, financial power of attorneys. You have a living will. That way, in the event something happens, that your kids are not responsible for telling, whether or not they're going to continue to give, life support and things like that. And so you can get that kind of stuff. If you need help on that, you can reach out to RoyMatlockJr.com. We have referrals on everything. If we don't do it, we have vetted people. Anything having to do with money, we have a number, we have a name, we have somebody. If we're not doing it ourselves, we have somebody that we can send you to. What we do is financial advisory. Today we have been talking about what I consider to be the defense. Everything begins when you start taking charge of your money. Taking charge of your money is getting educated. If you're listening right now, I hope that you've learned a lot today on the basics. The starting point is always education. You then, from education, you go get advice. Where do you get advice? I believe this, that if you're working with a great financial advisor, it's going to be the least expensive thing you've ever done because it's going to make you money. I see examples all the time where people come in and immediately we cut their taxes and we show them different ways of doing things. There's a lot of stuff that we can save money. So we do that. We get advice. We get education. We set a defense up. The defense is to avoid mistakes. Average financial mistake, $50,000 to $500,000 over your lifetime. It's just the way it is. So we try to avoid mistakes. That's your defense. We would then go on the offense. Next show, we will talk strictly about the offense. And when you think about the offense is, retirement plans, asset allocation, making sure that, you have your money in the most tax-advantaged investments, things of that nature that help you grow your money. We look at things like, passing money down in a tax-efficient way to your kids, all those kind of things. So that's what we do. My name is Roy Matlock Jr. If you would like to do a short phone call, reach out to us, 15-minute phone call to discover whether we would be good for you, 615-843-2999, or you can visit roymatlockjr.com. See you next week.